buy high quality businesses and stay in. And it's just like the future is just always uncertain. Hindsight's always 2020. That's just the way it is. And I certainly remember going to COVID and thinking I had no idea what's going to happen. And it's sort of like easy here in 2024 looking back and like, oh, of course I should have bought March or 2020, whenever it was. It was so clear that then it would blow over and then, the Fed would print a lot of money and things would go to the moon. That's just not the way it goes. Today, I'm going to do a solo episode where I'm going to talk about 10 things I learned about investing after more than 10 years with TIP. Let's just dive right into it. Point number 1, be careful who you listen to. So I think we're all prone to comparing ourselves with others, even if we know that we should not. And so if you're running a marathon, it's popular to say that you don't run against others, but you run against yourself. But at the same time, whenever you do that, people still ask about your time and they're not shy about telling you if they do it faster than you. And it's sort of like the same thing in investing. People want to talk about their portfolios, they want to talk about the track records, and definitely they want to talk about if they have made good stock picks in the past. And it's easier said than done. But one thing I learned is really to focus on your own goal. What is it that you want to achieve in investing? And for most people, it's either financial independence, certain track record, or perhaps it's both. But then you should start looking for friends on the path, not only with the same goal, but more importantly, those following a similar investing strategy as you. So for example, I tend to hold a small concentrated portfolio with high inactivity. So I currently only hold 5 stocks in my portfolio, and I really only have a meaningful allocation to 3 stocks. So I look for people who would put at least 5%, preferably more, of their portfolio in a specific stock, and that also don't want to move around in their portfolio too often. As you might already have noticed, the more specific you can be about your investment strategy, the better. So I, for example, just mentioned that I'm inactive in my portfolio, but all value investors you speak to, they all say that they're inactive. And so for some people, it means trading out of 20 stocks in a portfolio with 40 stocks annually. For me, inactivity means that I could easily go a year without adding or disposing of any stocks. And so you want to know where the other person is coming from whenever you're speaking with other investors. Not only whenever it comes to how many positions they have, but also how they define long-term investing. For example, on the investing side, Data Roma, it's always interesting to see what Guy Spier does because he moves so rarely. And you could include Norbert Liu and Li Lu in the same equation. And I should say that Data Roma is only for US positions, but I'm sure you're seeing where I'm going with this. And so if you would go to a website like that, I should say it's completely free and it's there for everyone to check out. One investor who became very successful from the movie The Big Short, that's Michael Burry. He's really an investor who swings for the fences, and he easily puts 5-10% in one position. But his turnover in his portfolio is also very high, and it's not aligned with my strategy. Sometimes I still check out his portfolio because I'm curious, but I don't really pay attention to what someone like Mike Burry is doing. Another thing I look for is the track record of the person I speak to. The better track record they have, the more I pay attention to what they're saying. Now, this doesn't mean that, say, a 10% CAGR, and whenever I say CAGR, it's compound annual growth rate. So it doesn't mean that a 10% CAGR investor can't be better than a 15% investor. It might simply mean that he's unlucky, but you have to go over the odds and have an idea of how they achieved that track record. So was it from a massive leveraged investment in Nvidia, where all his other stocks went bust? Or is this a strategy that only works in the bull market? And is the track record only achieved in bull market, for example? So there are a lot of different factors, not just the CAGR you have to pay attention to. Another thing is that I pay more attention to public and audited track records, which by definition few have. And I have no reason to believe that anyone is lying about the track record. That's not my point at all. But I prefer to have a third party to validate it, and also for me to engage with that investor and know how that's being achieved. And one thing is just that people define track record differently. To me, a track record includes markets that everyone has access to. For example, stocks and bonds. But it includes private equity and hedge funds because that's not something everyone has access to. So everyone defines that differently. Some investors might include real estate and other investments where they put in sweat equity. Some would disclose a track record that's dollar weighted, others a track record that's not. And I'm not saying that anything is right or wrong. It's just really important to know where the other person is coming from whenever they speak about their track record. And I should then also say that the focus on track record should not be confused with the scuttlebutt method. If you have the opportunity to speak with anyone, let's say that you're looking at a stock here. If you have an opportunity to speak with anyone who's working for that company, you can get a lot of valuable information. And just because they don't own any shares in the employer's company doesn't mean that what they say isn't useful. For example, I spoke with someone from Betson the other day. This is a company I'm invested in, and he didn't have any shares in the company. And so this gentleman, he couldn't give me any insights into the public filings. But again, that was not the premise. And just like the best leaders, often those who do not want it because they don't have the ambition for power, sometimes you also get the best feedback from non-investors. But when you do speak with fellow investors to learn what they invest in, it's very helpful to ask about the track records and investing process. And then you have the kicker here. Always make sure to remember that even investors with a great track record and solid investing process, they can still very often be wrong. All right, let's go to the second thing I learned about investing over the past decade here. Point number 2, don't screen for stocks. I mistakenly started my career in stock investing thinking that this was really just a numbers game. And the better a person were at math, the more you would win. And this was obviously the wrong approach. But the approach also implied that I should be using a stock screener. So, for example, I would be looking at a screen and then see a certain PE ratio, a certain debt to equity ratio, price to free cash flow, etc. Now, screeners can be a good place to start. But what I found was that screening for stocks forced the action too much. And I found myself in low quality businesses that was really outside of my circle of competence. What I do now is rather to look at other investors. And again, I would be looking at investors with a solid investment process and good track records. And then using their portfolio as a filter, and it really helps if you also know what the average price is for a position. And then I'll see if I can reverse engineer what they're doing. And of course, also it has to be within my circle of competences. And that really takes me to the third point I learned. Number 3, I realized that my circle of competence is just shrinking. And I thought I was very smart going into investing. And as a result, I was suddenly prone to overconfidence. And perhaps like others listening to this podcast, I had a bit of success before I was going into investing. And I thought I could figure something out as long as I wanted to learn something new. And so in other words, I would be thinking if I really wanted to understand the oil industry, it was just a question of reading up on the oil industry. And if I wanted to be good at investing in retail, I would just read up on retail. And so the irony is that with every passing year, I kind of feel like my circle of competence is getting smaller. And I thought it was the other way around. Let me just give you a quick example of this. I spoke with a member of our TIP mastermind community the other day. This is a community for listeners of TIP. And we just had a casual conversation about this idea I had about starting a serial acquirer. And then he asked me the obvious question, so what is your mode? And I had to admit that I likely only had one competitive advantage, for something like a serial acquirer if you were to start that up. And that would probably be in podcasting. And you do not find a lot of listed companies in podcasting. Getting a competitive advantage in investing is hard. And it just requires a lot more work than I originally thought. I'm a slow learner, and I also realized that it's not enough just to read the public filings. And I should also say, many don't read the public filings in the first place. You really have to go over and beyond to widen your circle of competence. So I think I just realized that I'm wired in a certain way. And there are so many fields in business that I just don't understand. And it doesn't really matter how hard I work. I just still don't understand it. And so if you look at my portfolio, I have 5 equity positions, and they're basically dividing into 3 buckets: capital allocation, advertising/media, and then gambling. And I've spent thousands of hours in various capacities in each of those 3 groups. And I come to realize that my track record has shown that unless I spent, I'm really sorry to say, thousands of hours in a specific industry, I've typically just not been very successful. And it's a sad reality, and I hope I can find a way to cut corners in the future, but so far it seems like only hard work pays off. In other words, I don't think my circle of competence has been shrinking. I think it's been just very narrow from the very start. And I should also say here before I would go to the fourth point that I don't think you need to spend thousands of hours widening your show competence. I really think I'm just a slow learner. Going to point 4 here. Read investing books, but study real businesses. So I remember going into TIP being really fascinated by everything that Warren Buffett was doing. And I had the idea at the time that other than my flawed idea that you should just be really good at math, I thought that you should read as many investing books as you could. And as much as I still read investing books today, because I can't help myself, after some time, I start to find a diminishing return to scale. And you also find a lot of conflicting information. That really goes to the other point I had at the top of the show about understanding where the other person is coming from whenever they're providing advice. But even if people come from the same place, they can say different things and you can easily get confused. And then I learned that it wasn't all investing books that Buffett read. He started his real businesses. And I learned that I feel too late. And I sometimes wonder if I read too many investing books. It's one of those things where you can read about how it is to be married and have kids, but it's really hard to know before you do it. And some of the best reading is to study 10Ks from a company that you find fascinating. And I think another thing that I've learned is that you should read the 10Ks not because you want to invest in the company, just because you want to learn about the business. And then perhaps sometimes you find it to be attractive to invest in. Reading business books about real businesses is really something I find useful, if not at least today, more useful than investing books. Now, I tend to gamify everything in life, and I'm sure many listeners to the podcast feel the same way. Some might already be financially dependent, and they just continue to accumulate capital because it's the new scoreboard. And then they would have people telling them that it's absolutely ridiculous because they can't take any money with them when they leave, as in when they die, and because money is meant to be spent. But I think it's for the same reason that probably a lot of people listening to this podcast also have competed in sports for no other reason than they love to play the game and even more to win. In a similar vein, I thought that I won the more investing books I read. And so if you read just an hour to a day, you can easily read one book per week. If you do it for a decade, you will make it to 500 books. And I realized that I could probably have been without a few hundred books and be just fine. I still enjoy reading. It's not because I have any regrets of that, but I do think I have been inefficient in my reading. And at least from an investing perspective, I would probably have benefited more if I spent that studying real businesses instead. Now, figuring out who to learn from is easier said than done. Multiple people have said to me over the years, especially at times where I had too much confidence in my own skill set in investing, that I could learn from everyone. And I do think that is a very nice and inclusive way of looking at the world. But I'll also be the first to say that your time and my time are likely better spent learning from Buffett about investing than John Doe that you meet on the street. That being said, life is not as simple as just learning from the people with the best skill set. Michael Jordan might be the best basketball player in history, but that doesn't make him the best coach. And if you allow me to go out on a tangent here, I often debate this with the host here on our network. We want to interview investors who have been beating the S&P 500 for longest and with the biggest margin. We really want We Study Billionaires to be the home of where the best investors are. And then at the same time, the investors with the best track records don't always make for the best episodes, and they don't always empower the listeners the most. And I like to compare this to the time in my youth where I put myself through college playing poker, and I didn't learn most from the best poker players. I learned from the best poker writers who eloquently outlined the game. But ironically, they didn't win or play the biggest games. And perhaps that was because the best players were busy winning, or simply because the best players are not always the best coaches, which is basically the example I had before there about Michael Jordan. Anyways, let me rope myself in and go back to talking about what I learned about investing. And it takes me to the next point, which is point 5, set up guardrails for yourself. Richard Feynman, the American theoretical physicist and Nobel Prize winner, he famously said, "The first principle is that you must not fool yourself, and you are the easiest person to fool." End quote. I do what I say, and I say what I do. And it's a wonderful and simple way to live your life. and it's a good way to invest, but it's also a terrible way to invest. So let me give you a somewhat silly example from real life first. So earlier this year, I was hosting in London for a mastermind community, and I was planning the community lunch, and I had twice communicated to the members where I wanted to host that. And I had hoped that the hotel had a private dining room, and I had some changes I wanted to make to the menu that they wouldn't accept. And so that's just the backdrop to that story. But I was teaming up with a close friend of mine who helped me plan the lunch, and I voiced my concern about that. And my friend is very opposite me. He doesn't do what he says, and he doesn't say what he does. And he's a very free-spirited person, doesn't plan for the future, does a wonderful job of living in the moment. And when he heard about my concerns, he kept suggesting other places. And he repeatedly, completely ignored my point about, hey, I already communicated to the community that this is where we're going to meet. He was perfectly happy doing everything at the last minute and changing his opinion. And so my point of this story is not to tell you that I'm terrible at planning lunch or events in general, which I am. But my point of telling this story is that I realized over the years that I'm wired in a certain way. My point is not saying that one approach is better than the other, even though I should say that being as rich as I am is probably not a good thing. My point is really that you should be aware of how you're wired and whether that works for you or against you. So back to investing. One set of guardrails I have is that I'm investing in a fund that can only be redeemed once a year in a brief window. I think many investors wouldn't like that idea. They'd like to have access to the capital at all times. But for me, it's great because it forces me to be inactive. Another set of guardrails I have is not to put more than 10% of my portfolio at cost into a single position. Now, as I mentioned before, I used to make a living playing no-limit poker. And in comparison, the stock market comes with very low volatility. And so whenever the S&P 500 dropped 12% in a single day, I know it sounds silly, but it's really mundane in comparison to the old days at the poker tables. Now, as I've grown older, I also learned that poker principles are not a good way to run family wealth. I also know now that I have a tendency to tolerate volatility well, and I probably have a tendency to tolerate it too well. So by capping myself at 10% at cost of a single position and then let my winners run, I allow myself to diversify more than may be natural to me. Again, my point is I want to set up guardrails to protect myself from myself. And we're all unique creatures, and I can't tell you how you should set up guardrails. But I do know it's very hard to change the way you are wired. So if you can set up rules for yourself that allows you to have your biases work for you instead of against you, that would be preferred. And that sort of takes me to the next point. Point number 6 of what I learned is do not look at your track record too often. I know that this is going to sound ridiculous, but it took me 10 years to look at my track record. I certainly don't recommend that you only look at your track record once a decade, and I think I've taken it too far, but I want to tell you why. When I started studying Warren Buffett, it became very clear to me that I needed to think very long term, and looking at my results every quarter would work against me. Unfortunately, my broker doesn't allow me to compare my returns on all of my equity portfolios, and for tax reasons, they're in separate accounts. So even if I want to invest in the same securities across my accounts, I would get different results simply due to investing timing. And so that would imply that I couldn't tell the track record of all my public equities. Now, there are services that could include not just my public equities, but also all my other assets. And this is just a quick side story. My broker works closely with the Danish authorities where I'm taxable and they do it for free. So changing to a US broker, which arguably would be a lot better, like more features, lower commissions or whatnot, it sort of would have been a good decision, and I could see my track record way sooner, but then, I would have to pay for someone else to do my taxes, and yada, yada, yada. So I had to weigh saving on cost versus knowing my track record in detail, and I could still obviously make a somewhat rough estimate of how well I was doing in the stock market. That being said, it started to become increasingly embarrassing whenever I got asked about my track record, and I really couldn't provide a good answer. And whenever a friend of mine for the mastermind community then recommended ShareSite, I didn't have a good excuse not to import my portfolio. I did an episode earlier this year with Clay about my track record that I would link to here in the show notes. It showed a 21.4% CAGR since January 1st, 2014, and that is against a 13%-ish CAGR for the S&P 500. And I've chosen 2014 because that was the year I started TIP together with Preston, and then I publicly started talking about my positions here on We Study Billionaires. A few notes to my track record. It's dollar weighted across any of my assets that trade on a public exchange. And since it's dollar weighted, it's a more conservative measure. And also, I should say for transparency reasons that I made my first investment in the stock market back in 2012. Now, 2012 and 2013 were just crazy bull years. And the S&P 500 went up by nearly 30% in 2013 alone. I haven't included the years in my track record because I don't have access to the broker I used back then, even though it would likely be good for my track record if I did. And as mentioned at the show's top, everyone is a genius in the bull market. I'm certainly no genius, and one thing that I'm thinking about for my own track record is how would I have done during the great financial crisis? The only bear market I've really experienced was during COVID, but there was such a short period of time. Like, how well would I have held my own during the great financial crisis back in 2008, where I wasn't invested? Who knows? And so it is one of the things I think about these days whenever you hear about all of these wonderful track records. When do they start? Do they start in 2009, whenever the market was trading at a very low multiple? Or were they riding a bull market, which you can definitely say that I was too? Or does it stretch back for decades across multiple recessions? I haven't looked at my track record since I did the episode with Clay earlier this year. I simply think it would be counterproductive, and I would be tempted to do irrational things regardless of whether or not I would do better in 2024 than my average so far. And so, for that reason, I aim to only look at my track record once a year, if not even less frequent. But at the same time, you need to find a balance between wanting to know how well you do. For example, if you're an active investor and you consistently underperform the market, you might consider various passive alternatives, and you likely don't want to wait 30 years to realize that you should have done so long ago. But at the same time, you also don't want to make yourself susceptible to doing stupid things by looking too much at your track record and moving around in your portfolio too often because you want the next quarter to be better. That takes me to point 7. Do not only have public equities in your portfolio. Knowing that stocks are real businesses, I thought whenever I started TIP that I would only hold stocks in my portfolio, and I thought diversification was only a question of holding enough stocks. This was before I studied financial history and learned that 7 out of the 10 biggest economies in 1900 had their stock market completely wiped out during the 20th century. I also learned how countries behaved in times of crisis, and that the stock market could close for a prolonged period of time, which ironically are the times that you need money the most. I considered and consider the US to be my home market and mainly look at US data. It also means that I'm susceptible to survivorship bias, because it implies that you can easily reach the conclusion that if you invest in the US, you can never lose money in the stock market as long as you're a long-term investor. Yet, I'm sure if you're Russian or if you're a German investor, you would have made the same claim about your country on the brink of the year 1900, only to see the entire wealth wiped out in the stock market. Today, roughly 60% of my liquid assets are in public equities. I find public equities to be a terrific asset class that I plan to always have exposure to, but history has taught me not to be 100% in stocks, and certainly not all in the same country. That takes me to point 8 of what I learned about investing, and that is run your track record 1,000 times. Whenever I look at my portfolio today, I ask myself, what if I ran it 1,000 times? How would I do? Most of us are probably inclined to what literature would call resulting. Resulting is when you judge the decision based on the result. For example, you might consider an investor with a 20% return over a decade better than someone who makes 15%. While it might be true, it doesn't mean that you know how much risk the former investor took to achieve his return. And many investors, including myself, have made good money investing in the US. You wouldn't expect anything less from investing in the greatest economy the world has ever seen. But then at the same time, I also have to ask myself, would the US be the best stock market to be invested in 1,000 out of 1,000 times? Capitalism and history are brutal, and they would probably suggest otherwise. And it's for the same reason that I invested a minority of my money with an asset manager buying public equities. Now, as it happens, and this is my humble brag, my returns have been significantly better than his over the past decade. But I do think if I ran his portfolio against mine in 1,000 lifetimes, he would probably come out as the winner more often than me. And even if he did not, which is impossible to know, I like to hedge myself against my own biases and vanity. And there's this paradox here where you have to believe that you are better than average to be an active investor, but then at the same time, you also know that only half can be better than the average investor. But if you don't believe it and have conviction in your decision, this stock market would just never allow you to beat it. As I turned 40 earlier this year, I also increasingly faced my own mortality. I had to assume that if I ran my life and my portfolio 1,000 times, at least few of those times, I would die prematurely. So I want to make sure that even if I don't wake up tomorrow, my family would be okay financially. And whenever you think about running your portfolio 1,000 times, you start to respect the process more than the results you have or have not achieved. For example, I used to think that hard money was a terrible investment, and perhaps it is. But I also grew up in Denmark thinking I would never have a war on my continent, and here we are with a war 1,000 kilometers away. I own hard money and include the returns in my track record, not because I'm 100% certain that it would improve my track record. If anything, history has shown that hard money is not a good investment, but hard money has proven more resilient in times of conflict than equities in many countries. And I want to be in a situation, like I mentioned before, that if there was a war and I didn't have access to my equities, and even if I died, my family would still be okay financially. It's a tall order, and as a result, you just make different decisions. So when you look at your portfolio, you have to identify what you're optimizing for. Do you optimize for the highest possible return? And are you willing to go broke in some of those 1,000 times? No problem. It's your portfolio and it's your decision. I have hard money, private equity, other asset classes than public equities in my portfolio because I approach investing with the idea of having to run the portfolio 1,000 times and be able to care for my loved ones as many, if not all, of those 1,000 times. It's surely a different way to think about portfolio. And that takes me to the next point. Point number 9, position sizing. This is one of the things I've changed my mind on the most over my investing career. And I don't expect to have it completely nailed down today. That being said, after trying and failing I don't know how many times, even after catching a break here and there more due to luck than skill, I want to present what I learned about position sizing. So I generally have 3 options whenever it comes to positions for my listed securities. The first option is 1%, the second one is 1 to 10%, and the third option is 10% plus. So let's break each of them down. A 1% position for me means that I've done proper research and have a general idea of what the valuation of the asset is. For example, if it's a stock, I would have read the most recent 10K, their previous earnings call, and have a pretty good idea of the competitive landscape. I might have at this time put in between 20 and 40 hours at this point. Sometimes a little less, other times significantly more. But what I've learned is that I don't really understand any of my investments before I owned it for some time. I simply process the information differently whenever I'm invested, and I pay more attention, but I'm also more susceptible to confirmation bias. When I started investing, I would put a large part of my portfolio into a single stock. And if bad news came out, I would be quick to dismiss it as being short-term and not fundamental to the business thesis. But I also come to realize that the more I invested in a single position, the more biased I also became that this bad news was indeed short-term. Knowing my own biases better today, I forced myself only to take a 1% starter position. Enough for me to pay attention, but not enough for me to give me too much confirmation bias whenever I process information about a stock. But like I mentioned, once I own a stock, I typically also get a much better understanding of what the value is of the stock. And oftentimes it's quite different than what I originally thought going into it. That allows me to exit it or simply hold on to it and add once the stock reaches an attractive valuation. And you would think that it would be possible to do that without allocating 1%, and it likely is for some. But for me, owning and learning more about a stock, if only 1%, it just gives me the conviction to scale up to a full position of 10%. Now, the second option is whenever I have a position size between 1 and 10%. These are stocks that I have conviction in and that are trading at an attractive valuation whenever I add. I will get closer to 10 the higher the conviction and the lower the opportunity cost. The opportunity cost here would be what other investments I have available. I also know that I'm often wrong and I can be sitting in an echo chamber with others who are bullish on the same stock as me, so I cap myself at 10%. If the position takes off, I simply let my winners run. And if a position becomes larger than, say, 10%, it typically means that I'm right in my thesis. And the way the math works in investing is that you want to ensure that you're not cutting your flowers and watering the weeds. However, the other side of the coin is that you should not lose money. And so making sure that you don't add to a position that you already have 10% or more in is a way to guard yourself against that. Now, I should say that 10% works for me. Perhaps it's 5% for you, perhaps it's 20% for you. It all depends on your risk tolerance and your financial goals. And just to paint a bit more color around that, if 10% sounds high, there's also a natural hedge for me. So I spend less than half of what I make. Currently, it's around 30%. So I would have cash inflow that I could put into the best investment opportunity in one of those positions that makes up less than 10% of my portfolio. So my biggest position above 10% automatically becomes smaller, everything else equal. And then I can funnel my cash into the best deemed risk versus reward opportunity. Like I mentioned before, this framework might be the best framework for me, but it doesn't mean it's the right thing for you. You might spend less or more of your disposable income than I do, or you want to be more concentrated or more diversified than me. All of that is good. And that takes me to the 10th and final point. Point number 10. What are the implicit assumptions of the advice you get? I interviewed Guy Spear earlier this year, and it was from him that I learned the framework of running a portfolio 1,000 times. In the interview, we discussed that premise, and I told him I only had 5 individual stocks. Now, I think Guy has 20-ish stocks in his portfolio. And I'm really going to paraphrase here, but he was basically saying that if you have 20 positions that are equally weighted, time will make sure that you eventually get concentrated in some of your positions, and you would have a different risk profile if you started with 20 positions. As always, Guy is absolutely right. It also shows the importance of understanding implicit assumptions when someone is giving you well-meaning advice. It's very hard not to look at the world from where you're standing. Guy has more of his wealth as a proportion of net worth in his equity portfolio than me, and he also has more of his family money in the fund. Also, he has investors who have the vast majority of their wealth with him. Add to that he's a different age than me and had different life experiences that have shaped him. So my point is that my circumstances are different, not only from Guy, but from you and everyone else listening to this podcast. I have a bigger part of my net worth in private equity than most, and I see the world through a different lens. Not a better lens, but a different lens because I had different life experiences and I'm just wired differently. And we're all unique that way and have to lean into it the best possible way for ourselves. While some people might not be able to sleep if they don't hold at least 50 stocks, I don't think I could sleep if I did. I want to read the filings of the companies I invest in, knowing what is happening with their competitors and everything else in between. I have other companies on my watch list that I want to invest in at the right time and the right price. And if you own 50 stocks and you want to be diligent about all of the filings, the competitive landscape, you have your own watch list, you could easily have to read 1,000 reports and filings annually. And if you just spend 1 hour on each, it's 20 hours per week. It's certainly doable if that is your full-time job, but I can't and won't carve out 20 hours every single week to look at my equity portfolio. Now, please don't get me wrong. Some investors would happily own 50 stocks, never read a single filing, and sleep well at night. That is just not how I'm wired. I need to be on top of my positions, and there is only so much time I want to spend on it. So ironically, owning 5 stocks gives me less stress than owning 50 stocks. Now, again, my point is not about how many stocks you should own, but rather when you hear advice, make sure you understand where the advice is coming from, and in turn, if it applies to you. More often than not, it's simply just not relevant. All right. So that was 10 of the most important things I learned after investing for more than a decade with TIP. When I started, I thought there was a right way and a wrong way to invest. Humbled by the stock market and life, I later learned how we all approach investing differently because of our circumstances. A good friend of mine recently turned 50, and he just sold his company and hadn't invested much in the stock market. He then asked me, how to do long-term investing. He wanted specifically to make 10x his money in a decade with very low risk, and then he would start spending the money that he made. So many of you might be listening to this thinking, that is an outrageous expectation. You might be thinking that 10 years isn't long-term investing in the first place, and waiting until you turn 50 years old cripples the element of compounding. Perhaps you are more stuck on the 10x in 10 years as being naive. It's something that is possible, but with low risk? That seems tough. Now, I can't fault you if you think any of this. It's easy to point fingers at others and say, the way that you invest is the right way. I certainly thought that often, but whenever I get the chance to really get to know the other person and where they're coming from with their portfolio, it's rare that it doesn't make sense what they want to do. My friend has been used to working very hard in his business, and like all entrepreneurs, he has learned that you need to act to create results. That is the way to get a positive feedback loop and then to pivot. 10 years is forever when you run your own business, and to buy stocks in the market and then sit on your hands isn't how most business owners are wired. Many entrepreneurs will tell you that being an entrepreneur in the first place comes with the lowest risk compared to being an employee, because if they do so, they would have to rely on the kindness of strangers. Whereas if they're business owners, they're in control. And then you would have many workers who collect a salary. They feel the very opposite and would never take the assumed risk of starting their own business. They would feel like investing in the stock market is like entering a casino. But here's the thing, no one is crazy, and we all shape our experiences and our own mental models of the world. My parents experienced the crazy high inflation in the 1970s and got burned in the stock market. And when you experience that, it's no wonder why they decided to tie up their wealth in real estate. Ever since I started investing in the stock market, it has gone up and to the right. I was still a student during the great financial crisis, and I hadn't invested a single dollar. As you also heard me talking about in this episode, I come from a background where playing no-limit poker paid the bills. So it's likely why I wouldn't mind putting 10% of my portfolio in a single position. I'm certainly wired to swing for the fences to my own detriment, and I have to guard myself against, my own biases. And we're just all complex creatures and full of paradoxes.
Hey everybody, it's Clay Finck here, host of We Study Billionaires. If you're looking for a network of like-minded value investors to talk stocks, share ideas, and embark on this journey of lifelong learning, I would encourage you to check out our TIP Mastermind community. The TIP Mastermind community has over 100 members and caters to private investors, portfolio managers, and high net worth individuals who are the most passionate fans of the show. In the community, my co-hosts Stig Brodersen, Kyle Grieve, and myself host weekly live Zoom calls that we record for the group. Hey everybody, welcome. Thank you for joining me here.
One of the things I really appreciate about this mastermind community is that you meet like-minded people from all over the world, and you have a chance to hang out with them, have a ton of fun, and also talk about investing.
Recent calls I've thoroughly enjoyed are a stock presentation on a recent addition to Kyle's portfolio, and a member spotlight with an investment professional based in London who's compounded his personal portfolio at 37% per year over the past decade. The community really allows us to dive in deeper on topics we typically don't cover on the podcast here. We also have in-person meetups each year in Omaha, New York City, and London. Stig just hosted a lunch and dinner in London with a small group of less than 10 people, making for intimate and personal discussions which are more difficult to get when you attend these larger investment conferences. In October of 2024, we have our meetups in New York City where we'll host 2 dinners in the city and a boat tour to see the beautiful skyline views. And if you're heading to Omaha in May, you can meet up with the community there too, which tends to be our most popular in-person event. I can assure you that I've met many people in the community that I hope to be lifelong friends with, and many members of the group have found similar connections as well. We truly have some amazing members, so if this is of interest to you, I would encourage you not to wait since we're capping the group at 150 members. To learn more, you can join the waitlist at theinvestorspodcast.com/mastermind. That's theinvestorspodcast.com/mastermind, or simply click the link in the description below. Now, back to the show.
I remember telling my mother when I was 8 or perhaps 9 years old and I collected pennies that I wanted to use them to save up for retirement. And the thought of spending more than 50% of my income today makes me nervous. Roughly spending, call it 30% of my income feels safe to me. My wife recently talked about the idea of buying a car. We never owned one, and the thought of incurring fixed costs it doesn't feel good to me. And it sounds like I'm a penny pincher, right? And I don't know if I am, but I also know I'm the same person that was looking at the S&P 500 dropping 12% in a single day during COVID and really hoping that the action would start soon. And most people would consider the behavior of the latter to be of a gambler, but wouldn't be able to square that circle with living well within their means. So let me just hit my point home that no one is crazy. What others do makes perfectly sense to them, and what you do makes perfectly sense to you. And for that reason, I also want to stress that this episode is what I learned about investing. It's not what you or anyone else has learned. And it also makes it so much harder to conclude what I know for sure. I strongly believe that for investors, having 15 uncorrelated assets is a great North Star for approaching most financial goals, and a wonderful way to protect yourself against your own biases. And I truly believe that you should apply the mental model of running your portfolio 1,000 times. But focusing on the process and not the result is much easier said than done. When I started TIP, I was a teacher at the local college. And back then, I knew as many teachers who thought they were below average at their craft as I today know investors who think they have a below average investment process. I've learned to approach investing similar to Buffett's metaphor about the ovarian lottery. So this is a concept proposed by Buffett to describe the randomness of birth. According to his concept, individuals do not have control over the circumstances they're born into, such as family wealth, country of birth, and their abilities. And there are so many other things that are determined by randomness. This is how I'm looking at investing as well, and why I keep coming back to this idea of running a portfolio 1,000 times. You are bound to have 10 baggers if you invest long enough. And some of the times you will have 100 baggers, meaning stocks that will make your money back 100 times. Is it then skill to find 100 baggers? I would say that it is. Is it luck? Well, perhaps luck is on the spectrum. Yes, you can certainly make yourself available to luck the more rocks you turn over, but you also need to have the luck to be able to access a brokerage account in the first place. Billions of people on this planet just can't. And yet, as imperfect as the science is between luck and skill, and as much as we all think that our investment process is above average, it still comes down to just that. What I learned about investing is that it helps to read. Read hundreds of books. Read hundreds of filings for public companies and continue to compound your knowledge and in turn your wealth. But only if you enjoy the process. And whenever you do, you will start to do pattern recognition. You'll see that everything that has happened in the financial markets has happened before. You will see that 10 years or even a lifetime isn't long in the grand scheme of things, and that we can all be fooled by randomness. You'll find that you can and should learn from other people's mistakes, but also that some things have to be learned by making the mistake yourself. You'll find that money can't buy you happiness, but it certainly can be a good start to taking out many of the things that makes you unhappy. Perhaps what investing in life will teach you is that it's not about the destination. The journey is the best part. Let's transition into the next segment. And for that segment, I invited my co-host, Clay Finck, to join me. Clay, I just listed the top 10 things I learned from investing. I won't ask you to name another 10, but I'm curious to hear, with your time in the market, could you list perhaps the top 3 things that you feel are, for you, have been evergreen and that you learned?
Of course. Well, that was a great episode, by the way. Thoroughly enjoyed it. And what a tough question. So, I kind of paused of, what does this question really mean? So I kind of treated it as lessons I would tell my younger self starting out. So this is really just lessons or things I would tell the younger version of me that knew nothing about investing going in. So when I joined TIP, I'm not sure I could have told you that I had an investment approach that I had settled on at that point in time. And that was until I had interviewed Chris Mayer on We Study Billionaires. That was episode 543. And Chris really helped drive home the point to me of buying and holding, these great, high quality, big winners in the stock market. But then it's also coupled with this approach of minimizing the potential downside by focusing on companies with owner operators and strong balance sheets. So his approach really deeply resonated with me, putting a high focus on business quality. And then I started discussing it on the show and bringing on similar types of guests. And I found that it really resonated with a lot of the listeners as well. So my number one lesson here is to really not be afraid of doing something like index fund investing or something that tends to be more safe and tends to be a comfortable approach for a lot of people. And doing that before you find an approach of individual stock investing that really suits your style and your temperament. So that way you're always participating in the market, but you may still be more interested in learning more about something like individual stocks. So I think the best approach is really the approach that you're likely to stick with for the long run. I think some people can fall for the trap of constantly changing their style. And then I believe that really just hampers their returns and their chances of doing well. So the second lesson I have here is tied to patience. And there are many aspects to this. So when you zoom way out, investing is a really long journey. I just recently turned 30, so I hope to be an investor for another 50 years. And whether you find a high quality business this month, 6 months from now, or 12 months from now, over the grand scheme of things, it really doesn't matter all that much. But in the moment, it feels like it matters a lot. So I can imagine many investors in Apple in 2005, they feel like they missed out when Apple went from $1 a share to $2 a share, split adjusted. Today, Apple's over $200 a share. So I would tell my younger self not to rush into your investments and don't rush to find your style. And once you find a stock you like, have the patience to get in it over time and just let it compound. And, some stocks that I've bought over the years, some have grown significantly faster than I expected, and some have either gone nowhere or gone down. And from the outset, I really couldn't, foresee which was going to be which. And I've kept the patience of holding on to a lot of these companies and just seeing how they pan out over the next few years and continue to reevaluate and be patient in holding them. And then the last point on patience is to sort of reiterate this point of to be patient in building your position. So through my job here at TIP, I get paid every month and I have cash coming in to deploy. And I typically don't hold cash other than for personal reasons. So for example, I'm going to be doing some traveling and going to Austin, and I just wanted to have some extra cash for personal reasons because you never know what life will throw at you sometimes. And by the way, if any listeners are in the Austin area, I'd love to connect. So feel free to reach out if you'll be around this winter. But in terms of investing, I just like to keep a low cash position when just looking at my portfolio. And given that I want to own these high quality businesses, I value time in the market over timing the market. And I'm also no valuation expert, and timing the dips of some of these names isn't a game I always want to play. And the irony with high quality investing is that some of my most expensive looking stocks also tend to be my best performers, and we'll see if it continues to be that way in the years to come. And I'm reminded of a Charlie Munger quote that whoever said that getting rich was going to be easy. My third lesson here is to be humble. The world is likely a lot more uncertain than we believe it to be, and things can change rather quickly. So the market has a way of really humbling me personally whenever I get really confident in my positions. And I remember when I first started getting into this game of investing and starting to learn more in around 2016, 2017. And many people around that time, I recall, said that the market was overvalued and it was time to maybe have more cash or sit in cash. And since the start of 2017, with the benefit of hindsight, we can see that the S&P 500 is up over 50% since then. So remaining humble can really help you keep an open mind, take in new ideas, and be willing to admit when you're wrong. And if you aren't willing to consider these new ideas, then you won't evolve as an investor. And I really believe that value investors are going to need to continue to evolve because the world is just changing faster than it ever has. And Stig, one thing you've told me that's really stuck with me is that you kind of joked that you've been operating TIP for the past 10 years, and each year, more and more people seem to say that we're in a highly uncertain environment. And it really makes sense initially. And that's not to say that they're wrong, but once you hear it enough times, you start to think that uncertainty is just a key part of the game. And for me, the lesson is that uncertainty can present a lot of opportunity. I guess another reason to be humble is that as someone who picks stocks, I need to understand that the odds are likely stacked against me in terms of doing better than something like the index. And if I do beat the market over, say, the next 10 years, a large part of it may be just simply due to luck. And Hendrik Bessenbinder, he shared with me in a recent interview that just 4% of stocks since 1926 accounted for all of the net wealth creation in the United States. If you don't hold the stocks in that elite category, then earning high returns may prove to be pretty difficult.
Yeah, and that's so well said, Clay. If I can just go back to what you said there about uncertainty, I remember whenever I started investing, and so I think I made my first investment, 2012-ish or so in the stock market. I put in most of my money as I remember it, but I do remember whenever we then started TIP and I learned more about Buffett, and I saw, oh, okay, Buffett has whatever kind of percent in cash. I should probably also be in cash. Obviously, I had no idea why he was having so much cash, and there were good reason for it, and the way it was with insurance and having that buffer and just managing him, billions of dollars. And I was like, it looks uncertain. I should have cash so I can buy the dip. And then you sit there for some time and you're like, and I'm probably colored by, 2013, 14, like all of those years being bull markets. But I just remember, at least for some time, thinking, and that's why I need cash. And now I'm just thinking, to your point, buy high quality businesses and stay in. And it's just like the future is just always uncertain. And hindsight's always 20/20. That's just the way it is. And I certainly remember going to COVID and thinking, I had no idea what's going to happen. And it's sort of like easy here in 2024, looking back and like, oh, of course I should have bought, in March or 2020, whenever it was. It was so clear that then it would blow over and then, the Fed would print a lot of money and things would go to the moon. I was like, I don't remember the period as I have 100% conviction in that happening and 0% that it's not going to get worse. That's just not the way it goes. Anyways, yes, the future is always uncertain. So thank you for bringing that up. And also, like, hindsight's 2020, like we talked about so many times here on the show. And I should probably say on that note, I can't believe we didn't set up the mastermind community before. I don't have a good reason for it. I remember whenever we talked about it last year before Omaha, and I had this crazy idea that, we should do a stock investing course because that's exactly what the world needs. Just yet another stock investing course. And you were sort of like nice about it, but you're like, no, let's not do that. Then you came up with the idea of the online community, and then we could meet up in Omaha and all the good stuff. I think I've been surprised to learn how much I benefited from being a member. Obviously, I'm super, super biased as I'm saying this, but I thought originally that it would really be about stock investing. And I have learned about stock investing, so please don't get me wrong. But I think what I enjoy more is that I met so many people in the community with shared interests, shared values. And I don't think that it's a surprise that some of them just become your friends because, let me just give you one example. So you vet all the applicants that's coming in, Clay, and one of the questions you ask are like, what's your favorite books? And, I don't want to give your list sort of like a GTC. That's not the intention. But, many of the listeners would be like, Paul Charles Almanac, Rich Wise Happier. So, like, you just sort of like know that you might have found a kindred spirit whenever they say, like, those are their favorite books. And, they probably don't know too many people living, in the next block. Yeah, they might say they're into investing, but like, if you love those books, you're into a very specific form of investment done a very specific way. And so I don't know if this is the best way of putting it, but, I visited London not too long ago and I met up with the mastermind community there in person. My metaphor is sort of like, if this was a date, it's not, I should say, we're just meeting up with fellow investors. But if this was a date, you're not starting from scratch. It's almost like you're starting from the fifth date because you already have all of those other shared values in place.
Yeah, that's a really great point, Stig. And like you, I just really continue to be impressed by the members who are interested in joining over time. I mean, some are former CEOs of a global family business, some manage a family office or manage a fund full time. And I also really like having new members join who are interested in sharing with the community and also just interested in connecting and networking with others in the group. And admittedly, many of these members are certainly much smarter than me when it comes to stock investing. So selfishly, I just see it as a win-win for everybody. And some members are also open to doing things like sharing their portfolios on a call or just joining for like a member spotlight, different things that we do with the group. And there's certainly plenty to nerd out on. And when you're connecting with others in the community or getting on Circle, you aren't going to be wasting your time because each member has been vetted.
Yeah, and I should probably, with all my biases, then say that I so much appreciate the high caliber here of the community members. And of course, we're all busy, and that's just the way it is. But one of the things I found to be quite interesting is that there's so many in our community who are financially in a place where they don't need to work. But then at the same time, even if you don't need to work, most people want to work and they love working, they love setting new goals. And so I think it creates this wonderful environment where everyone is respectful of each other's time. And then at the same time, what I've certainly benefited from is that many of the members have full control of their own schedule. So we can still do things, from 9 to 5, which has been absolutely wonderful. And we also cover a lot of different time zones. So 9 to 5 is obviously different from host to host, but also from team member to team member. Another thing is just also that with the flexibility that our members have, they just live very interesting lives because they have different opportunities presented for them. So I want to sort of like tell an old story. So there's this old story, and I should say this is a metaphor, hopefully for a community. But so this expert were asked to come and fix this plan, and he looked at the plan for 10 minutes, all the machinery there, and he put an X on one of the machines, and that X basically said, this is the part of the machine you need to get replaced, and then the plan will stop working again. And so whenever he was discussing the prices for our services with the plant owner said that he would only pay him for 10 minutes of work. And then the expert said, you're not paying me for the 10 minutes of work, you're paying me for the 10 years. It took me to tell you just in 10 minutes, this is the part of the machine you need to have replaced. And so, what I love about the community is that there's so many experts in their respective fields, and you get so much bang for your buck per minute that you put in. And I don't think, I should also say, Clay, I don't think you give yourself enough credit whenever you say that. There are a lot of people who are smarter about stock investing than you. I don't think that's the case. I think, for example, one of the presentations we just had was the one about Brunello Cucinelli. Lance and Edwin from a community make that presentation, and then they're the experts in that. And yes, they're much smarter than we are about that specific stock. But that's sort of like what I love about the community. Like, we have a lot of different experts in stock investing, but also in other fields. So it's more like, in this setting, you're the novice, and then the other setting, you're the expert. And it always changes. So another thing I really like about the mastermind community.
Yeah, they say that you're the average of the 5 people you spend the most time with. And the community is certainly a great opportunity to surround yourself with people who are the experts in fields that you aren't an expert in. And it really means a lot to hear you say that. And you make a good point that we do try and be mindful of people's time. And I think it's the same thing here on the podcast. When a guest starts rambling, you and I aren't afraid to just remove it from the audio to respect the listener's time. And, we try our best to ask the most thoughtful questions we can to make the episode as valuable as possible. So every week in the vetting process, I'm hopping on calls all the time with prospective members of the community to, share more so they can learn more about it and see if it's the right fit for them. And it's not uncommon for some people to hesitate to join because of the price. And I really don't blame them, because when you think about it, we're really appealing to value investors who always want to ensure they're getting a good margin of safety and that the value is greater than the price, whether they're at the grocery store or sifting through a watch list of stocks. And recently, one prospective member asked me if he could speak with another member that actually ended up living in his local area. And to the best of my knowledge, he spoke very highly of the community. But I've also been in this role long enough to realize that many people tend to tell you exactly what you want to hear. So I would also say that some members have even found it so valuable that they've switched from monthly to annual billing, and that's because they really want to be in it for the long term. So I would also say that the community, like with a lot of things, it's really not for everyone, which is a good thing. And one of the things that you told me when we launched was that if you become the community for everyone, then eventually you'll become a community for no one. And since you mentioned members highly valuing their time, I oftentimes feel bad about asking some members to present, but I really only do it around once a year. So while one person might be doing all this prep work for presentations, and like that Brunello call, you see that our members put a lot of prep work into, sharing around these topics. But they also get the benefit of tuning into 20 plus other presentations throughout the year. So again, I really see it as a win-win for everyone. So some of my favorites from this year, Wyatt, who's an equity analyst, he did an excellent stock presentation on MasterCard. And then Joe, he previously worked at Microsoft for 25 years, and he's done a portfolio review and just opened up, he was totally open book, shared his portfolio and shared his thesis around many of the names he owns. So it really creates this positive feedback loop where everyone really cares about that quality, is really mindful of others' time as well, as you pointed out.
Yeah, and another thing, Clay, is that I realized, how many of our members who come from a background typically I don't know if I should say typically, but I've noticed that there are quite a few who have a background where they run a successful business on their own, and now, they accumulated some wealth and they want to, invest in stocks. And I kind of find it to be quite interesting because I came from the world of stock investing, and I'm sort of looking into perhaps buying private businesses. And I don't know if the case is that the grass is just always greener on the other side. There was one community member who posted something as a reply to me where he said that he'd gone through a number of transactions, some of them closed, some of them didn't, and he was just so happy looking at the public markets that are run by some of the best managers in the world that was just trading at 15, 20 times. And it was just so nice because it was so passive. And I was like, wait, that's all wrong. You come from this world where, small businesses trade for 3 times earnings, 5 times earnings. And he was like, yes, but no. Whenever you start to normalize the earnings and put in the sweat equity, and it doesn't really trade at 3 times earnings. I kind of feel that it was interesting. And again, the grass might always be green on the other side. I don't know. But, one thing I recently had been looking into, like I mentioned, is being potentially acquiring private businesses. And, so far it's just been an absolute wonderful experience, because I remember whenever I started studying stock investing in depth and, reading book after book, and new things open up every time, and you were speaking with other investors, and you were just on such a steep learning curve. And I don't want this to come across as I can't learn new things about stock investing. I certainly can. What's interesting about looking into private businesses is that there's so many in our mastermind community who are successful business owners. And I would actually say quite a few of them are like, you don't know what you're getting into here, Stig. But anyways, it's just been so interesting to have a chance to hang out with them online, even a few of them in person, and just learn from them. And it's almost like I'm rediscovering stock investing for the first time. And I learn so much every time I started the field. So I guess this is also my way of saying that from the size of the group we are, and I think we are 115-ish, if you're interested in serial acquirers or mining rights or nano caps, or in my case, businesses, it really doesn't matter which kind of niche you're looking into. You'll find a 1, 2, perhaps a handful of experts who just love to work with you on that and discuss with you. I think that's the ethos of our community, really wanting to pay forward.
Yeah, I mean, I can certainly see why public markets are just so attractive to someone with a private equity experience. It reminds me of Monish. He grew up and his father was an entrepreneur. And then he went off and got a safe, secure job. And then his dad's like, okay, it's time to go and start your own business. And Monish said, don't you remember all the pain we went through? It's like, Stig, don't you see how difficult this is going to be? So I'm actually really curious. When it comes to private equity, you've been looking into getting more involved in this space yourself. So what's that experience been like for you, and where are you at in the process?
Yeah, so I should probably preface this by saying I don't know what I'm doing at all. So that's going to be my starting point. So with that said, I can't say I've overpromised anything. I've been looking to work on a few different projects, and I should probably say that the mastermind community has been very helpful, but in different ways. So one of the projects I've been looking at has been to buy a small Canadian business. So in this case, the reason why I'm doing it like that is I have a potential business partner in Canada who would run the project. And if I even take one step back again, I would say that I generally have the framework that you can only be obsessed with one business at a time. But you need someone who is obsessed in that business. Every business needs someone who's obsessed. And for me, that's TIP. And so whenever I am looking into buy a business in Canada, which probably comes across as very random, it's because I think I found the right person to team up with, and then I can invest alongside him, but he can be the one who is obsessed, which is sort of like it's an important detail I just wanted to mention. So in this specific case, this was actually a Canadian business that was specializing in taxes. And so some of you might be like, you don't know anything about taxes in Canada. And you're absolutely right, I don't. So the intention was more to buy a business together with a business partner and then hire someone who had the competences to do it. Long story, it's like there were a ton of traffic to this online business, 5 times the size of TIP, and it was just under monetized to a large extent. So I was speaking with one of the community members who happened to be a tax accountant in Canada. Not in the sense of, hey, let's do business together and let's have you invest, but just more like, we're looking at this business opportunity. What are your thoughts? And he was super nice about it, but he was also like, be careful here. You have to consider X, Y, Z. And so whenever we did that, it became pretty clear that this was not something we should do. But I think really where I benefited from that was just to save a bunch of time and just be like, no, that business opportunity, even though we could buy a ton of traffic for very little money, it was just not the right fit for us with the type of structure we have. Great, let's move on to the next thing. So that's one thing I'm working on. So another thing I would say is that, many people here who listen to this probably heard Buffett talking about you don't have to swing it at every pitch. And that's sort of like how I feel about opening myself up to potentially acquiring private businesses. I don't know if I'm widening the field that I can sort of like play in by saying it's not just public equities, but also private equity, or if I'm just venturing outside my circle of competence. I think time will tell. And I wouldn't be surprised at all, Clay, if we're sitting here in a year having this discussion. I'm like, I just wasted a year of my life trying to find the right business and it just didn't work out. So anyways, I'm working on this project here with a friend and potential business partner in Canada. And I would say that that has been an interesting experience. And it's been an interesting experience in more than one way, because one of the challenges that I face is, and I think perhaps a lot of the listeners can resonate with that, is that they don't feel that they can find the time to run the business, either because they already have a job or because they already run the business. And so it's been kind of like interesting to explore this idea of being a junior partner. Junior partner in the sense of, I don't want to own more than 49% of the equity, but I really want to team up with someone and together control the business. So it's not like we necessarily have to replace management, but him and I would need to have control of the business. And we want someone who is obsessed about the business. It's interesting, this idea of teaming up with someone else. Just like, I learned a lot from teaming up with Preston, and finding like that one person is kind of interesting because I'm sort of like working with 2 different models and speaking with quite a few people about how to set up the right structure. There's something to be said about teaming up with someone who has a proven track record and don't need the money, which in this case would be the situation with a Canadian business partner. And a part of me is like, it makes me nervous. I understand whenever people need money and how they behave whenever they need money. But a part of me is also like, okay, if you already exited a company, sold it, don't need to work a day in your life, and you still work all the time, perhaps that's a good sign that you want to team up with this person so he can do it again together with you. And then then there's sort of like the other way of looking at it, which is working with someone who might not be as in a financial privileged situation, but then really wants to prove himself and is very, very hungry. And that's sort of like a different type of structure. And I think I've seen both things go right and seen both things go wrong. Like I've really seen those people who have been very, very successful and they just can't flip that switch off and quote unquote enjoy life because their version of enjoying life is just to continue working. And then I've seen people who strive for financial freedom, and then once they achieved it, they're done. Like they're done. So anyways, and this is a long response, which probably also shows I don't really know exactly what I'm doing, which is how I prefaced my original response. I'm also looking at buying small businesses in Scandinavia or the UK. And I set up a website at theinvestorspodcast.com/acquisition. I'll make sure to link to that in the show note. And I would shamelessly like to hear from any of the listeners if they have a company for sale. And on the website, I've set up like different criteria. It's not just like send me an email, but there are some things about return on invested capital and net profit margins and how much profit and size of all of that stuff. You can find all of that on the website. And if I can just tie that back to the mastermind community, I just found it very helpful to speak with the community members about private business because so many people come from the background of running their own private business, either as an executive or they might have control of it. It might be a family business. It might be themselves who started originally. And I should also stress that the intention of our community is by no means to raise funds or have anyone solicit their services. That's very much not what it's all about. It's really more to have a group of people where you can support each other and help each other in whatever direction, whatever kind of journey that you're on. Our members are investors by heart, and I think that type of investing mindset is very helpful. And so, for example, like I mentioned before, I was speaking with a tax accountant in our mastermind community who's also an investor. So whenever you discuss like, so what would it take to run this website with all like millions of people visiting? And so he wasn't just looking at it from this is what he would do as an accountant, but also like as an investor, this is what I would say for you to get XYZ return. And I think just that angle is just extremely helpful whenever you're an investor yourself.
Yeah, I mean, some of these people have just seen so much as it relates to private equity, public equities, to business and whatnot. That all sounds wonderful and very exciting. So I hope it all pans out well for you and you don't see yourself running back super fast to public equity investing and whatnot. And a lot of what you're saying, I think, refers to just betting on the jockey instead of betting on the horse, because it seems that as you look at smaller and smaller companies, the one or two people running that business becomes more and more critical, is what I've seen. Well, to give closing thoughts here on the community, if this is something that sounds interesting to you, to our listeners today, they're welcome to join our waitlist. That's at theinvestorspodcast.com/mastermind, and you'll be hearing back from us here soon. I'll also mention that we have some fun calls really coming up that I'm definitely looking forward to. So we have a bull and bear discussion on Technion. So that's actually a holding of mine and a previous holding of Stig's. And then we also have a stock presentation by my co-host, Kyle Grieve, on natural resource partners. So definitely always have some really fun calls coming up. We host a number of different social hours. We bring in special guests and whatnot, but you can learn more about the community at our website.
Fantastic. Clay, thank you so much for joining me for this second segment here of the show.
Thank you, Stig.
All right. So with that, I think we're going to end the episode. Thank you so much for tuning in, and we'll see you back again next week.
I started an investment in Spotify in December 2022, and I bought it at $78. And it's up 231%, but it's like 1% of my portfolio. And so if I've been smart, I would have made a full-size bet of 10%. And I saw what they were doing in the podcasting space, and I only invested very little. So I kind of feel that was a mistake, even though you could say I made a profit. And so this is something I struggle with because I feel I had the same conviction in Spotify as I had whenever I was building a position in Alibaba. But one worked out and the other one didn't.